Welcome back, dividend investors. Today we're going to take a closer look at Costco, stock ticker COST. Currently they are trading at $561. Year to date they are up 24%, which is indeed a cut above some of its peers. Over the last year they are up only 4%, but if we zoom out, they are up a massive amount. Actually, if we take a closer look at how it compares versus S&P 500, you can see over the last 5 years it has massively outperformed the index, returning 161% versus the S&P 500 index of 57%. And this is mainly due to being a very well-run company with growing revenues and EPS, and they also offer a modest dividend that has been increasing for 18 years. If we take a look at some of their fundamental financials, you can see here the revenue has gone from September 2018, 141 billion to 235 billion in the trailing 12 months. If you scroll down a bit to find the net income, you can also see it has almost doubled from 3.1 billion to 6 billion in the last 12 months. Looking at some of the diluted EPS, you can also see they are indeed returning value to shareholders, around $7 back in September 2018 and up to $3.50 in the last 12 months. Which means that the dividend per share sits around $4. And if you go into the cash flow statement and find the free cash flow per share, you can easily see here that they have roughly $13 of cash flow per share. So even though you subtract the $4 to the dividend, there's a lot of free cash flow wiggle room left after Costco has paid out their dividends. That can be used, for example, for stocks buybacks. And if you want to check how they are generating that free cash flow, you can see cash from operations gone up from 5.7 billion to 9.8 billion, even though the capital expenditure hasn't gone up that much. Started at 2.9 billion and up now to around 4. So they have increased, obviously, the capital expenditures, but not at all in the same amount as how much free cash flow they are generating from that capital expenditure. And now that we have learned some details about the free cash flow from Costco, we also want to take a closer look at the dividend scorecard. You can see here the dividend yield forward going is 0.73%. That turns out to an annual payout of around $4 as mentioned, which means the payout ratio is around 27%, way below that 60% limit I would like it to be at. You can see the 5-year growth rate sits above 12% and the dividend has been grown for the last 18 years. So there's still a lot of room for Costco to grow the dividend to eventually maybe become a dividend king. Before we jump into the stock screener and calculate the intrinsic value of Costco, I quickly want to take a look at how Wall Street thinks about Costco. You can see here that the Wall Street actually has it as a buy rating, with 20 analysts having a strong buy rating on Costco. 10 has it as a hold, and then we have 6 around buy and only 1 on the sell side. If you come down here, you can actually see the upside is supposed to be pretty limited, only a 1% upside from the average of all the analysts. Obviously, we do have some with a very high price target going into the future, but the average sits currently around the same price that we are in right now. So let's jump back into a stock screener and find out the intrinsic value of Costco. You can see here earnings per share is around 3.5 as we've mentioned. EPS growth for the last 5 years seems to be negative. I can't really understand why, because as we saw from the financial statement, they have indeed grown it quite a lot. And then we come down here to the PE ratio and take a look. You can see it sits at around 36, which is extremely high. But if you compare that to the 5-year average, you can actually see that we are pretty close to the average, which could indicate that Costco right now sits about a fairly value deal. The revenue over the last 5 years has grown around 8% in a CAGR, so annual rate, and the 52-week high is pretty close to where the price is right now. They do have a very low amount of debt. Net debt to EBITDA is actually negative, which I'm not really sure how that is calculated anyway, but anything below 3 is really nice, I would like to see. Analyst targets mentioned around the same price as we are right now, and we also do have a lot of margins over here. You can see the operating margin sits around 11, which is pretty good for a consumer staple such as Costco. Operating margin around 30% is more in line with what I would believe, but they actually have grown the margin 1.6% over the last 5 years. Profit margin 2.5 sits around what I would expect it to be. And then we come down here and take a look at some of the ratios. And we do have some quite high ratios, but that is to be expected from a company like Costco that trades a bit of a premium, I dare say. As we saw earlier, the payout ratio sits here just under around 26-27%. Then the 3-year and the 5-year dividend growth rate is roughly around the 12%, which is really good to see. Return on invested capital and return on equity sits really well as well, I would like to see here. You can see the return on invested capital is at 14 and the 5-year average is 13. So I believe this is something they can continually provide. Same with the return on equity, 28%. The 5-year average sits around 25. So they are really good at generating profit from their invested capital and their equity. And if you jump into our dividend data tab here and zoom in a little bit, you can see here what we really want to see here is some steady growth of the dividend. You can see here over the last 10 years, 12.5%, and then you basically have around these 12, 11, 13, 14% every year. So they are indeed growing their dividend very steadily and very predictably, which is something we really would like to see. You can see that special dividend has been paid out a couple of years back in 15, 17 and back in 20 as well, which was probably some really good years for Costco. So they decided to pay out a little bit special dividend, which is also something we can see here. It's a bit obfuscated due to some of the special dividends, so we can't really see the dividend growth. But as you can see here down in the bottom, they are growing the dividend ever so slightly every quarter or every year, sorry. Coming down also here to the dividend yield theory, you can see here sits just slightly overvalued according to the dividend yield theory when we are in the red area. So no discount to be had, at least according to dividend yield theory. But let's jump into some of our other valuation methods, such as a discounted cash flow, where we do take the free cash flow from the different years. We then apply a growth rate for some future free cash flows. We can then discount them back to a present value and calculate an intrinsic value based on that. And then we do have the dividend discount model, where we have a dividend payout from different years, combine that with the weighted average cost of capital and the growth rate of the dividend. We can then calculate an intrinsic value. In this case, the growth rate is that much higher than the weighted average cost of capital, so it will result in a negative value. Multiples valuation, where we do take some comparable companies such as Walmart and Target and so on. We then compare their median PEs to the EPS from Costco and then calculate a stock price. We also do have Graham's revised valuation model, where we do take the formula here on the left and punch in everything we need, and then it gives us intrinsic value for Costco. Then again, we also do have the price to earnings variation, where we take the average from the last 5 years of the PE ratio, combine that with the EPS from Costco, then we arrive at intrinsic value as well. Same can be said here for the free cash flow variation, just with the price to free cash flow ratio instead of the PE ratio. We then take the free cash flow per share, and then we also arrive at an intrinsic value for Costco. Last one up is the Peter Lynch model, which takes the growth rate, the dividend yield, and the PE ratio, combining in the Peter Lynch formula, and then we also get an intrinsic value. Before we jump into the summary, thank you so much for watching. If you haven't done so already, please subscribe to the channel for more videos in the future. Now let's jump into the summary and then zoom in a little bit more so we can see everything a little bit better. We do have our valuation methods over here on the left. I did exclude some of them. I did exclude the Graham's, the dividend discount, and the Peter Lynch valuation. The dividend discount was negative, so that's why. And the Graham's and Peter Lynch valuation, I don't think they really apply for a company such as Costco, so I also excluded those. That gives us an intrinsic value of $380 roughly. With the current price being at $561, it could indicate that it's actually trading roughly a double above its current intrinsic value. Then we also do want to take a margin of safety. So we do have our margin of safety calculator over here on the right. It takes some of the values such as in return on invested capital, EPS growth from this page, and then actually combine that to a margin of safety. We start with 25, and then depending on some of the metrics here, as you can see, it either deducts or adds something. So in this case, it actually ends up being 0. But I've written down here that the margin of safety can't go below 0. In this case, it's actually -10. So even if we are willing to pay a premium and then we say -10 over here, margin of safety, then the acceptable buy price becomes $417. But Costco is a very well-run company, as we saw in the financials and some of the other figures. They have strong fundamentals, they have growing revenues and growing the EPS, and they also provide this modest dividend that we did see earlier. The Costco has significant growth opportunity through their international expansion and also the customer loyalty. However, I do believe the valuation of Costco at the current time is too high. For me personally, it makes it a very unattractive investment at the current time. Also, as you can see, the analyst target price was pretty much in line with the current price from now on. However, I do also believe that Costco is pretty much always traded at a premium. So if you want to go into the stock, I don't think it's a too bad place to do it. Actually, as we saw, the PE and the dividend yield theory was pretty much in line with the current averages. So I think if you want to go in and do like the company's outlook and prospects in the future, I think it could do a lot worse than buying in now. As Warren Buffett famously said, it's much better to buy a wonderful company at a fair price than a fair company at a wonderful price. Thank you so much for watching, and I'll be seeing you in the next video.